Hey, it's Stephen Young here, host of the Savvy or Surrender podcast. And for today's episode, I actually have a special for you. It is an interview that I did with Jonna Weber. She is the host of the Real Estate Investing for Life podcast. And so she had me on her podcast, and we thought we would share it so that we both had it on our podcast so that we could reach as many people as possible to learn more about real estate investing and the 10 myths surrounding it. So take a listen to this, and I would love for you if you would subscribe, like, share it, and get the word out. If you have any thoughts, concerns, anything you want to share with me, I would love to hear from you. You can email us at podcast@savvytaxstrategies.com.
Hey, Stephen, thanks so much for joining us on Real Estate Investing for Life today. I know as we're recording this, it's mid-winter and you are starting into the busy tax prep season. So I appreciate you taking a little time out of your day today with us.
Absolutely. Excited to be here. Love you guys, and I know Rain and everything that you're doing with it. So
Thank you. Well, we love having you be a part of it. And as we grow the show, one thing that's really cool is we're actually getting listeners from all over the country, and we've even gotten some downloads from Europe lately, which has been really fun. So for all of you listening, wherever you are, I think you're going to take away really solid, actionable strategies today. And we're going to address some real basic and thought-provoking questions related to taxes in general as it relates to real estate investing. If you are just delving into real estate investing, this is definitely the show for you. So make sure you keep your notebook handy and maybe listen to this episode more than once, because you're going to find some real gems here. And Stephen, I think it's appropriate we're coming to you right now out of the start of tax season, and people are really thinking about taxes and what all this means. But tell the audience a little bit about yourself and your background.
yeah, absolutely. So I first started doing taxes about 24, 25 years ago. Wanted to be able to help my wife not have to work outside the home anymore. When we got married, we were going to expand our family. And so I started doing taxes on the side and did that for the majority of the last quarter century or so. And then about 2.5 years ago, decided I wanted to focus more on tax strategy and not just simply tax preparing. And so I got a designation in tax strategy work. I got my enrolled agent or EA designation, which specializes in taxes. IRS's top designation authorizes me to work in all 50 states. So you mentioned you have people listening to you all over the country, which my podcast, the same thing. And I'm getting some people in Europe. It's really cool to see. I don't know if they're truly there or if it's a VPN or something like that, but whatever, I welcome everybody. And so with that additional education, really just being able to focus on real estate investors, small business owners, helping them to maximize their profit and then keep that profit by using tax strategies to help them minimize their tax liability.
I love it. And following up on that Europe thing, this is a total side note, but Karen, if you're listening, hi, welcome. And I actually had a call with Karen this morning. She is in England and she's a listener of the show. So
Very
it was
cool.
really fun to be able to have that conversation with Karen,
Yeah,
know
that's
that she
great.
is actually listening over there. So this is great. Well, let's dive in. As you are familiar with, a lot of our audience listening out here, you're high income earners or you're business owners, and you're just starting that journey into real estate. And I think it's really important. And Stephen, I'll let you kind of speak to this. Why is it important to get an idea of tax strategy and what that part of your strategy that you're using for real estate investing? Why is it important to get a hold of it at the very beginning?
Yeah, it really is. And of course, it's one of the last things that people want to think about, right? Like nobody
Right.
wants to think about the tax situation when they get into real estate investing. It's more exciting to go on Zillow and look for hours on doom scrolling through houses to try to find. But it's so important because every strategy really ends up being, or every real estate investment way of doing it, I guess, way of investing into real estate kind of has a different means of taxing. So what I mean by that is if you're a fix and flipper, your tax strategy is completely different than if you are an Airbnb host. And so if you're a high income W-2 earner, a lot of the times your income from real estate is passive and you don't get to write off losses and depreciation. But if you are doing an Airbnb and you have a short-term rental, that rule, there's what's called a short-term loophole. I hate the word loophole because that makes it sound like it's illegal. It's not. It's completely legal. But that's kind of the nickname for it is the short-term loophole. But anyways, it taxes different. So every strategy that you come up with or every type of real estate investing that you want to do, you want to be aware at least of the potential tax implications. Is it going to tax you capital gains? Is it going to be ordinary income? Am I going to have to pay taxes next year on all this income that I made on this fix and flip? So at least being aware of the situation and then document everything that you possibly can.
Okay. Yeah. Well, that's a lot coming at us. So, bottom line is when someone's looking at one thing I talk about a lot with new real estate investors is what strategy they're going to employ and what makes sense for their lives, their financial situation. I imagine it's kind of the same, right? When talking to a tax strategist,
It,
because no two situations are like, is it a different situation when somebody is a high income earner that is working, maybe getting what's, we call them W-2 employees, right? If they're a W-2 employee, is that a different situation than if they are a business owner? Are there different conversations to be had?
a little bit, but not nearly as much as if like they were a real estate professional. So let's say them or their spouse are able to qualify to be a real estate professional. They're able to get their real estate license maybe, which isn't even a requirement necessarily to get what's called reps status or real estate professional status. But it helps if you have your real estate license just because it kind of shows that you're a little more serious in being a real estate professional. But you could do property management. You could do real estate investing full time, and that's just what qualifies you for rep status. But so business owner, W-2 doesn't really matter. It's more a matter of how much time you're dedicating to real estate and what type of real estate investing you're doing.
Okay, yeah, that was one of the questions I was going to ask because some people haven't heard of like the real estate professional status. We'll get into that, but I think that's really important. I was thinking of some of the questions that I've been asked recently, and I was hoping that you could address them. Again, looking through the lens of someone that's just getting started with real estate investing. And some of these things I think you might say, oh, this is an attorney question. There's attorney questions, and then there are tax advisor questions, right? And I
Right.
think a lot of times people get them confused. So, for instance, a question that came from our audience that wanted to ask you is, do I need an LLC before I first buy a property? Does that have anything to do with tax strategy, or is that a legal thing?
It doesn't, and it's one of the biggest misnomers really out there. I think is that they think, oh, I need to have an LLC or excuse me, or I need to have an LLC for tax purposes or something. And really, the LLC is a legal liability company, right? So it's a completely legal thing. In fact, the IRS considers an LLC to be what they call a disregarded entity, meaning it's still filed on your personal tax return. So if let's say you buy a rental and now we have to add a Schedule E to your personal tax form, but it doesn't matter if that's on just you own it on your own or if you own it as an LLC, it's still going to be the same thing. So there's two separate things. There's legal and there's tax. And so LLC
Right.
doesn't make a difference.
Okay, it's pass through.
Yeah.
It's more of a protection thing for your
Yeah.
property. And
Now,
also yeah,
so I
go
was just going to
ahead.
say, now staying in my lane, I would highly suggest talking to an attorney or setting up an LLC to protect you when you buy that rental, especially if you're going to have a lot of equity in it. But, an LLC is only as good as the person that's managing it. So, there's a lot of, and again, I want to stay in my lane, but a lawyer can tell you there's a lot of ways to be able to pierce that veil and go after the people that are behind the LLC. And so, you can get an LLC, but if you're not going to set it up correctly and do all the things you need to do, it ultimately isn't going to matter.
Okay. Well, okay, so let's just say a lot of people need to purchase as a sole proprietor anyway because they need to get a loan,
Yep.
especially if they're just getting started. So if that's the case, should everybody always get a business checking account, keep separate records, all that good stuff?
Yeah, even if you're just buying it on your own personal name, you definitely want to get a personal or a separate checking account for that property or for that part of the business so that you can not commingle the money. You can have it all separate, what expenses are what. And if your record keeping isn't the best, if you're not great at, you don't want to, QuickBooks isn't really necessary for somebody who's buying one property or even a couple of properties, probably. There's other free options out there, but even Excel works. Or worst case scenario, you have your separate business checking account and you can pull those statements and then just highlight, okay, this was for, utilities, this was for an office expense, whatever it might be. And that way you can categorize things correctly for the taxes.
Okay, yeah, that makes sense. I remember starting with spreadsheets too when
Yeah.
I first had our first couple, and it worked. But you want to take advantage of the fact that you have those rentals. And that's another question, leads me to another question, because people get confused a lot. And I know I've been confused on, like, if you own a rental and you are not a real estate professional, which we'll talk about, are there specific tax advantages, or is it just something that you're just buying for appreciation down the road?
There are some great tax advantages to simply having a rental. One of them obviously is of course now you have expenses that could be attributed towards the rental potentially as well. So meaning things like a home office, internet usage, phone usage, things like that are going towards your rental business that you can write off at least a portion of those expenses now towards your rental business. So you have that opportunity. If you're not already a business owner and you don't have that opportunity to write off some of those things, now you do because you're in the rental business. So that's the first one. And then the second one, of course,
Great point.
is depreciation. That's a huge deduction to be able to help with somebody that's buying rentals. You get to write off the interest on a loan, but you don't get to write off the principal because the depreciation is what takes care of that part. And so the better you can take advantage of the depreciation, the better opportunity you have and the better your tax returns are going to look.
Okay, that was a question that I had. This whole, the buzzword of depreciation, and we throw it around, and those of us that have been investing for a while, we have a better understanding. But when I first started, I certainly didn't. Just in layman's terms, what is depreciation?
Yeah, so the easiest way to look at depreciation is it's really the way for you taking a fixed asset and taking off or removing the usage of said item. So maybe it's easier if you look at like say a car, right? You buy a car, it's got 0 miles on it, it's brand new. Obviously, over time, the more miles you use, the more depleted that vehicle is. Right? It has a lifespan. Let's call it 100,000 miles. Most cars, if you're good, you can go longer than that. But let's just call it 100,000 miles. The longer you go, the less lifespan is left, right? You get to 80,000 miles, you only have 20,000 miles left. Well, the same thing applies to real estate. They look at a house that's 20 years old, 30 years old, and you buy it and you've got to depreciate it over time because its useful life is getting less and less the older it gets. And so that's why, things like the furniture or the HVAC system or whatever, they might have a different depreciation basis because it gets used up faster than the house itself.
Okay. Okay. As a new investor, sometimes I'll hear I know that new investors are hearing the term like cost seg thrown
Yes.
around. And
Oh,
that's
yes.
that's a big buzzword right now,
It
because I know
is.
with the big beautiful bill, that made it really a good opportunity again. But for most people that are purchasing, let's just say a single family rental, is that even part of the discussion or equation, or is that for like big commercial kind of
No,
things?
no, it should really be part of the equation discussion for every type of rental. Even a condo, where you don't have all the walls aren't owned by you necessarily, even those have an opportunity for depreciation or for cost segregation. And the big thing there, and the reason why the One Big Beautiful Bill made it so popular again is because bonus depreciation, when the Tax Cuts and Jobs Act first came out in 2017, they introduced something called bonus depreciation, where you could take certain items that were going to be depreciating faster, and you could say, hey, I want to take it all at once. And so rather than having to take a car again, let's just say 5 years or 7 years, rather than having to break it up 20% a year for 5 years, you're able to take it all up front. Not necessarily the smartest thing to do with a car because now you still have this car payment, but whatever, you can do it. The idea with real estate, specifically with cost segregation, is, again, like I mentioned before, the flooring, the HVAC, some of the appliances and fixtures, those things aren't going to last. If you own a home, you're supposed to depreciate that over 27 and a half years. So all of those things aren't going to last longer, right? There's no way your HVAC system is going to last that long. Your roof might, but probably not. Most of those are at best 25 years. I just had to replace my roof, and my house is only like 17 years old. So most of those are going to have to be replaced faster. So if you do a cost segregation study, the official way you're supposed to do it is you have a cost segregation officially done. They're typically somewhere between, for a single family home, $3,000 to $5,000 if you have an expert actually come out and do it. There's also what's called a remote cost segregation. In fact, I think there's like remotecostseg.com or something. And, I don't want to blow. If you have a sponsor for a remote cost seg, great. I know you did have somebody at the event
Maven.
recently.
They're a part of our group, actually.
Yeah. Okay. Well, and I love the guy that came out a couple months ago, and he was great. In fact, we've connected, and hopefully he'll be on my podcast here pretty soon as well.
Okay.
Oh no, he was the 1031 guy I was thinking of.
Russell.
I'm sorry. Yeah, I'm getting him confused. But
yes, we do have a cost seg. Great guy in the group. So anyone needs one, I can hook you up.
Perfect. Yeah. So there's that way, right? So you have the full-fledged one, you have the remote one, which is usually about half as much, because what they're doing is just taking pictures, and then they're having a surveyor actually kind of look at it, or an engineer look at it and determine what should be depreciated faster. And then the other way is you're kind of playing you're playing with fire with the IRS, because they can easily come back if you don't have an official cost segregation done. But the other way is to say, okay, well, it's, I think it's 40% of the building. And so then you separate it out. But essentially what you're doing is you're just depreciating it a little bit faster than the rest of the building that's at 27 and a half years.
Okay, gotcha. So definitely part of the equation. And so if someone meets a new investor, is looking at a potential purchase, is that part of the conversation that you would have with them on a
it definitely should be, to at least consider it. Because one of the biggest myths that I have, and I had told you, I kind of came up with a list of the top 10 myths with real estate investing and taxes. One of the big myths out there is that they don't have to depreciate, that they just choose not to, or they don't even know about it, and so they didn't do it at all. And what the myth is that it just doesn't exist, or it doesn't matter, from when in reality, the IRS is, whether you've depreciated or not, the IRS takes that as depreciation. And so they're calculating it. So you might as well.
Gotcha. Okay. Hey, let's get into some of the other myths, because I know you're talking with people on a daily basis about this. What are you hearing, and what are those myths?
Yeah. So the first one, talking about the high income earners, is myth number one is that rental losses always offset my W-2 or other income. And that really, again, plays into what type of real estate investor are you? There's three types. You have your passive real estate investor, who's just buying a property, but they still have their high income earning job or low income earning job, whatever it might be, but they're not actively a real estate investor as a full-time job.
Right.
So if you're passive, and then if you're active, well, you can show that you're working at least 100 hours in the business. Maybe you're self-managing it. You don't have a property manager. Maybe you're going out there and you're selecting the tenant, you're doing the lawn and gardening or whatever it might be, right? So you're an active investor, and then you can use more of the losses, and really the depreciation. Ideally, the depreciation is really only where the losses are. But we all know, we buy a long-term rental, it's barely cash flowing. We have to replace the HVAC system, and all of a sudden now it's negative, right? So you might be negative anyways. We even before depreciation. Yeah, exactly. I just had a client. He was like, "Yeah, this was cash flowing, and then I had to buy a $10,000 HVAC system." Well, there goes that. So that happens, and then there's that next one is the active, right? So we got passive, we got active, and then the third one is real estate professional status. So each one of those types of real estate investor gets a different amount of their W-2 income that can be written off. So if the myth is rental losses always offset my W-2 other income, it's not true. Depends on what type of status you are and how much of that's going to get written off.
I love how you segment into those three categories. That's great.
Absolutely. And then myth number two is all rental real estate is passive, no exceptions. And we just kind of talked about that again with those three categories. So a lot of to me, a lot of just by asking questions to my clients, I can tell that they're more active than they are passive, right? Usually, pretty much everybody is going to be an active real estate investor. Like I said before, you're going on Zillow every night. You're looking at properties. Maybe you're making a lot of offers, and you're looking at the deals at least. You're going out, you're doing open houses. To me, you're qualifying as active. And so now you have a little bit more of those losses that you can write off against your other income or your active income. So it's not always necessarily going to be passive. Myth number 3, depreciation is optional and won't matter when I sell. So that was the one that we just kind of talked about. And the other part that goes with that is, see, I had another myth in here, I think, that talks about how depreciation continues until my basis hits 0. It's myth number 9. And so really, so what that means is a lot of times you'll take the property and you'll say, okay, we're going to depreciate it all the way down to 0, right? So if it was $100,000, let's call it a $270,000 home. So every year for the next 27 years, we're going to depreciate $10,000. But that's not really how depreciation works, because what we're supposed to look at is what's the salvage value of the property, or whatever it is, the asset at the end of the depreciation cycle. Meaning, if we buy a house and we depreciate it over 27 and a half years, can we really say that in 27 and a half years, there's no value to that property? There probably still will be, right? Maybe it's not worth as much, but there's still going to be some value there, especially when we're talking about real estate. So you have to enter a salvage value there, and then you depreciate to that amount, not just simply to 0. A lot of people do that with cars. They'll say, okay, I'm going to depreciate this, whereas a $100,000 truck, I'm going to depreciate it over the next 5 years, $20,000 a year. But in year 5, that $100,000 truck's not going to be depreciated to 0. There is some salvage value there, unless you totally kill it. So,
well, I'm going to forward pace because on that note, on the depreciation, if you've owned a property, because we have a lot of people in our community that have just owned maybe 1, 2, 3 properties, and they've owned them for 20 to 30 years. If you've owned a property for 25 years, are you looking at, you're pretty much at the end of your depreciation line, and it might be time to get a replacement property?
Absolutely. That's one of the big reasons why you should be
I'm
looking.
sitting there in that position.
Yeah.
So.
Yeah, absolutely. Because now you have no depreciation left, right? And so now you need to look at doing a 1031 exchange or something and get into another property.
Okay.
Yeah, absolutely.
And for those that are new to the investing world, just in 30 seconds, what's a 1031 exchange?
All right. And that actually is myth number 4. A 1031 like-kind exchange eliminates taxes forever. And so a 1031 exchange takes the value or the equity that you have in one property, and it moves it over to a new like-kind property. So let's say you sell a single-family residence, A, and you have $100,000 in there after your basis. And we won't get into all of the basis, but let's just say it's $100,000 is your basis. You sell it. Now you have this $200,000 property. So you have $100,000 in equity. Well, you could pay taxes on that $100,000, or you could move it to another like kind property. And there's timelines and all that kind of stuff, which is basis for another episode, right? So when you move that equity into another property, you essentially what you're doing is you're kicking it down the road. So with the myth, it says that it eliminates taxes forever. It doesn't eliminate taxes forever. It eliminates it until you're finally done selling properties. And then at some point, either you die and you move those properties you gift them to somebody else, and then they have a new basis, and then maybe the taxes are eliminated forever. But that's pretty much the only way. Otherwise, let's say I'm 70 years old. I'm like, you know what? I'm tired of tenants. I'm going to sell this property. You sell it. Now you've got to recapture all of those taxes. So,
right.
It does come back eventually.
Where it makes sense, but
it's a great strategy. Yeah, it's an absolutely great strategy, but it doesn't eliminate the taxes forever. It just kind of moves them down.
Right. Yeah. Oh, for sure. Okay. You have another myth for us?
Yeah. Myth number 5, mortgage interest is always deductible no matter the loan. And that certainly is not going to be the case. It depends on the type of loan and the type of property that you're buying. And so it can be, but there's also, even with the Tax Cuts and Jobs Act, they maxed depreciation we've been on the depreciation kick. They maxed the mortgage interest deduction at $750,000. So that might come into play. So there's a few things there. Usually the interest is deductible, and then like I said, the principal that you're paying that gets applied for from doing the depreciation.
Okay, great. I,
Myth.
oh, go ahead. You
Yeah,
go ahead.
sorry. Okay. I don't want to take up too much time. If we, get, if I'm going too slow, if I'm getting too wordy, just let me know.
No, there's just a couple
Kick me
questions I
off.
want to get in for
Oh,
you. So
okay. All right.
but I want to hear what you have to say.
We'll
This
do
is
we'll do
cool.
these last ones quick. Myth number 6
Yeah.
is every landlord automatically gets the 20% QBI deduction. And I don't want to get into all the weeds of the QBI deduction, but basically it's just that's not true. So essentially what that means is, let's say you own a commercial building and
Mhm.
you rent it out to me, an accountant. You may not get that 20% QBI because I'm a different type of business that doesn't qualify for that deduction. And QBI stands for qualified business interest. And so there's a
Okay.
deduction on your personal tax form for being in business. Basically, you get to write off 20% of the income. And so that may not necessarily qualify. You got to be careful of who you rent to be able to get that additional deduction, basically.
Oh, okay. Yeah, we're gonna have to talk about that a little bit more offline.
Myth number 7 is I can use the home sale exclusion on any property I sell, on any property I sell. And so that one is really talking about the 2 years out of 5. You have to live in the property for 2 years. And so obviously you can't always use that exclusion. And a lot of times what I'll do is when I'm talking to clients that have house hacked, where they lived in a property for a few years and then they moved out and they bought another property and they held on to it. If they're getting close to that 5 years, maybe look at, let's go ahead and sell, because we can still sell without having any capital gains because we lived in it for those 2 years. So that could be one strategy. I know long-term hold and all of that kind of stuff, sometimes it makes sense, but other times it might make sense, especially if you're right there at the that $500,000 of capital gains that you can wipe out, might be worth doing it.
Mm-hmm. I love that strategy.
And then myth 8, passive credits all become fully usable when I dispose of the activity. Let's just say no, not necessarily true. So the passive credits, all that means is if you're a passive real estate investor and you don't get to write off all that depreciation, all the losses, they just kind of roll over until eventually, because you only get $3,000 a year is what that's capped at. And so they just keep rolling over every year until you finally get to use them. Well, if you dispose of the property, a lot of times they just get wiped out and you lose out on those credits.
Okay.
And then the last one is myth 10, all profit on sale of rental real estate is capital gain. And that's not true. Your depreciation is actually ordinary income. So it just depends on what type of property it is and how much of depreciation you have versus how much equity gain you have. Some of it could be capital gains. Some of it could be ordinary income. Another good reason to do the 1031 exchange.
Okay. Yeah, and it's something, if you're listening out there and you're a realtor, or if you're working with a realtor, I mean, don't try and answer those questions yourself. I would say, like, talk to someone, a tax advisor, to really know. And there's nothing like getting a surprise at tax year right after you sold a property when you really have no idea what your taxation is. I've seen a lot of people get surprised in that realm. And a lot of times in my days as a realtor, I wouldn't even let someone list a rental until they knew what their gain was going to be and that they had full eyes open, because I've just heard too many horror stories of people thinking they weren't going to be taxed on that
Yeah,
income and that gain. So it can be a kind of a pinch that people get
absolutely.
into. So,
Absolutely. Yeah. And then, what I find happens is I call it the ostrich effect, where I deal with a lot of clients that they've got 3, 4, 5 years, 10 years of back taxes that they haven't filed. And most of the time it's because something new happened in their life that what created uncertainty, and they just, rather than deal with it, they buried their head in the pillow. And so real estate tends to be that way because they, maybe they started as a real estate agent and they didn't take taxes out of their commissions and they didn't know how to handle that. And now they're afraid of how much they owe in taxes. So rather than file their tax return and deal with it, they just bury their head in the pillow and they pretend that it doesn't exist. And then 5 years down the road, they're like, oh my gosh, this is too much. I've got to handle this. It's better, like you're
okay.
saying, know in advance, have the conversation, just that way you can be prepared for it and not get so far behind that then it just becomes this huge weight on your shoulders.
I love that advice. Ounce of prevention. It solves so much worry and anxiety later.
Yes.
Circling back to the high income earner and someone that is doing really well in their job or their career, and maybe they're not. I know we both share a passion for business ownership, and there's a whole nother conversation related to the advantages of business ownership. But if someone comes to you and is a high income earner and just feels like they're getting killed on taxes, um, do you have any quick tips or like first things that you'll ask them to look at and consider? And is real estate one of those things?
Yeah, real estate is right there at the top. The only thing that
Okay.
might be before that, I mean, starting a business, right? If they've got time, if they've got a specialization or something that they can do where they can start a business, that's always great. But ultimately, the goal of a business shouldn't be simply for write-offs, right? I
Right.
mean,
You
even the
want loss
IRS
every year after
says,
year.
yeah, yeah, even the IRS says, hey, 2 out of 5 years you need to be making some money, right? So maybe the first couple of years you can write off some things, but eventually you need to show that you're going to make some money. So starting a small business isn't necessarily a great write-off strategy, but it is a great way to be able to start being able to look at other write-offs like your phone and home office and that kind of stuff. But as far as strategies go to really be able to shelter the income, I think real estate it's one of my favorite ways. There is also equipment financing or equipment leasing where you can buy a large piece of equipment and you get the depreciation, you get some increase every month, every quarter, you get a check. So you make some money and then you also have the depreciation there. But the big difference is when you sell that property in 6 years, it hasn't appreciated. It's depreciated by about 40%. So you don't get
Mm.
that backside like you do on real estate. I mean, there's a reason why, the top wealthiest people, other than maybe Elon or Jeff Bezos, are real estate. So,
Yeah. Yeah. No, I've got a couple of examples. Um, I've got family members that have, done great businesses, but they funneled their assets and their cash flow into real estate. And I tell you, I was meeting with someone last year. I ran into someone at a resort in Florida last year, and let's just call him Bob. He was actually an accountant. He had just recently closed or passed on his accounting firm in the Midwest, and he had had a couple of hot toddies or something. He was very chatty that night, but he leaned in, and so he goes, "I'm going to tell you something." He goes, "I did a great business, as an accountant, but the real money is in real estate. And that's why I'm here retired today." But I thought, touche, that is so true. And so that's a segue into business owners, because a lot of our listeners are also, they're business owners that are dipping their toes into the thought of real estate investing. And I know that's a big sweet spot for you and who you serve, Stephen, with business owners.
absolutely.
So, why are business owners uniquely positioned to consider adding real estate to their wealth strategy?
Usually it's because the amount of cash that they get, depending obviously on the type of business, but especially if they're a contractor where they're getting large sums of money, or they're a real estate agent and they're getting these large commissions rather than
Mhm.
blowing it on, jewelry or clothes or cars or whatever. Or if you're a contractor or a boat,
Yeah.
if you reinvest that and you put it into real estate, not only do you have the write-offs then of buying the real estate, but then you also are just you're furthering the generational wealth in your family, which for me that's for some people maybe that's not a thing, but for me that's a huge thing. I want to be able to change the financial destiny of my family. I want to be a Rockefeller. I want to be a Walton, right? So in order to do that, real estate is probably the best strategy to be able to do that.
I love that. And I think something we both probably agree on is something that we see is that sometimes people, if they're having a success in either their business, maybe they're just engineer or a physician or something, and they're making great income, or they're a very profitable business owner. I'll see them after they've dropped that completely to try and go full time into real estate investing, because that's how they're going to make their fortune. But meanwhile, they lose their income source to be able to create that cash flow to invest in those hard assets. And I know it can be a tricky thing, but I think I'm a believer that if you've got a great income and you're enjoying it, like make more of that money and
Yeah.
funnel it into something long term so that you
Yeah.
have options.
I agree. And the whole multiple streams of income thing that's become so in vogue, and I've definitely done it. I have found doesn't work very well, at least for me. I like to have the horse blinders on, and rather than trying to say I have six businesses, I want to have one that does really well. But that's being said, having something like real estate where you can be a little more passive if you choose to be, that
Hmm.
that grows the wealth exponentially depending on how you're doing it or what. Like it just gives you that opportunity to further enhance your lifestyle, further enhance your generational wealth, all those things, while still focusing on the main thing that is the main thing. Right. I think there's a book out
Right.
there that says the main thing is the main thing until it's not the main thing or something. You want you want your main business to be the main thing until you're ready to sell the accounting practice and just live off of real estate. So
Exactly. Go hang out in the bar in Florida on the beach, like I met that gentleman.
exactly.
Well, Stephen, these have been great tips. Thank you so much for sharing. And I love how you can speak from a perspective of both, high income earners, it's just whether they have a great job out there that they're enjoying, how to utilize some of that cash flow. And then, of course, the business owners. And we could have a whole nother show about business owners, but I know you address a lot of that directly on your podcast. Tell folks about where they can find you and the podcast that you've got, because I'm getting so much out of it.
Yeah, thank you so much. So my podcast is Savvy or Surrender. I call myself the SOS for the IRS. So SOS, Savvy or Surrender. And you can check it out
Oh, I
anywhere.
just got that. I love that.
Yeah, so Apple, Spotify, pretty much anywhere. YouTube, I guess, is like the number one podcast platform. So it's on YouTube as well. You can, just stare at my face or listen to me in the background or something. We've got 20 episodes in. I just shot the 20th episode today, so not nearly as far as you've gone, but I'm working on it, trying to do one a week. And it's all about tax strategy, finances, helping you with financial statements, all those incredibly exciting things that everybody wants to know about. I talk about. So
Well, it's important. We're getting in tax season, and this is when people are really interested in this stuff for about a month or two. And
yep,
then some people put
exactly.
their head in the sand again. But let's all about to stay on top of it together this year and get some better tax deductions next year. This is good.
Absolutely. And, I want to really compliment you and everything that you've done with Idaho Real Estate Investor Network. I think I've been in the atmosphere now for 13, 14 months and just really love what you've put together. You talk about kind of your listeners. I find it interesting. Your listeners on your podcast are very similar to what I have found the people that come to Idaho REIN events. You've got some people that have reached out to me that have dozens of properties, are developing, and then you have some that are brand new that are just trying to dip their toe in and see if real estate is even the game that they want to be in. And your education and the events, I feel like, really cater to everybody and provides great value. So if anybody's out there, they want to join or they're thinking about joining, I would highly suggest that. I have found a lot of value in it just as a person going to the events. So
Oh my gosh, thank you. That is so kind, Stephen. And
absolutely.
another bonus is like you're hanging out at our events. And so if you want a chance to meet Stephen face to face, this is a great opportunity. And you're absolutely right, a big mix. And there's something special about collaboration and figuring out how to get all these tips and tricks together. So
Definitely.
I thank you for that. And yes, we'd love to see you all at the next event. And we are going to keep up this conversation. I'm sure you'll be hearing more of Stephen in future episodes and some speaking at some of our events in the future. So we're just glad to have you as part of the community and such a supporter of Idaho REIN, Stephen. And let's continue this conversation. I appreciate it. I've got some more questions that have already perked up, and I know we're going to be having you on some other calls soon. And thank you for listening once again. If you enjoyed this episode and you want to hear more about like figuring out what kind of investor you are, I encourage you to go back and catch some few of our past episodes of figuring out whether you're that passive investor or a more active investor, because it's really important to get that right based on what your individual strategy is. Go and grow and have an amazing week.
Thanks so much.